It's my extreme pleasure to introduce Michael Ohlrogge from Stanford University, working with a longtime friend of this risk management seminar, Kai Gieske. This is a joint work with Kai, no. Kai has lots of fantastic research in our direction. And the title of today's talk is Bank Capital and Risk-Taking, a Loan Level Analysis.
Great. Well, thank you so much for the introduction. And I will say, even though it's not technically joint work with Kai Gieske, he is my advisor. This is my dissertation project, so he's certainly very involved in giving feedback and all of that. So his spirit is very much alive in this work. And it's a delight to be here to join all of you. I recognize a number of you from when I was here a few years ago presenting, so it's good to see both new and familiar faces. If at any point you have questions or anything like that, terminology or not certain if something makes sense, maybe I made an error, just feel free to speak up in real time. That would keep things lively. As Lisa said, I'm a doctoral candidate in the MS&E, or Management Science and Engineering department at Stanford. I also just recently graduated from the law school there. My interests in research are at the intersection of law and finance, in particular financial regulation and how that interacts with financial markets. And so that's, in a lot of respects, related to today's talk and the initial inspiration for it. So the research question I'm going to be investigating in this work is, does high leverage create an incentive for banks to make riskier investments than if they had lower leverage? And so there's a number of factors that motivate this kind of investigation. One of the big ones is that all of us saw very tangibly in the recent financial crisis that the investing decisions that banks make have a huge impact on the real economy. And so if we can better understand what are the influences that determine what kind of investment decisions banks are going to make, it can help us better understand maybe what's going on with the economy because of the large role that the banks play and the risks that they're taking play in that. So that is one of the reasons. Another reason that this is pretty interesting to investigate is, I'm going to talk about it in a little bit, there's a lot of financial theory that predicts that there may be a relationship of this sort, that higher leverage may well create incentives for increasing risk. I'm not quite sure what kind of background you folks have, but if any of you, one of the simplest ways to summarize at least some of that theory is if you think about an option pricing model and you think about a corporation and the owners of the corporation's equity, that equity can be considered as an option on the corporation's assets. As you folks know, if you've done sort of basic option pricing, the value of that option is going to go up with the volatility of the underlier. And so there's a variety of financial theory that comes sort of based on that initial intuition and much more sort of development of it that predicts that there might be this kind of a relationship that high leverage might lead to high risk. Also, part of that theory, though, is it predicts not only the leverage leading to risk, but also potentially leverage leading to a lower net present value in overall investments. Now, there's a variety of mechanisms through which that can happen. Actually, some of Lisa's work has been looking at leverage in portfolio investing, showing lower returns in certain situations from that. There's an aspect there, but there's also questions about the incentives of the corporation that is highly leveraged and what kind of investments are going to be optimal for the perspective of the equity holders might not be the assets that have the ultimate net present value when you consider both the equity holders and the debt holders, or when you consider sort of a social net present value of those investments. And so one of the reasons this is also interesting is we want to know, and what the formal name for this is called the asset substitution problem. And because banks play such a huge role in the economy in allocating trillions and trillions of dollars of credit, if there is an asset substitution problem going on with their investing, if there is a situation in which, because of high leverage possibly, they're making less efficient investments than they might otherwise would if they had lower leverage, that can have huge implications for the efficiency of the economy as a whole. So we want to know about that. And finally, there is the matter of prudential regulation. So I'm going to talk a lot about something called bank capital in this paper. And since this is a class, I'll give a brief overview of it right now, just in case you haven't encountered it before. So when we talk about leverage, we're talking about the value of assets of a corporation divided by the value of its equity. And when we talk about capital, it's in a lot of respects, to give a simplification, it's basically the inverse of leverage. And it's a little bit different actually. Here, I'll write it down. So the simplest definition of capital we're going to say it's assets minus liabilities divided by assets. So in other words, this right here, this we're talking about essentially the net worth of a firm, and in particular the bank, the value of its assets minus its liabilities, and then divided by its assets. And so in some respects we're asking what percentage of the total assets of this bank does the net worth of the company reflect? Or in other words, so we're kind of asking, when you've got a company, you've got two broad groups of people who are putting money into that company. You've got the owners, the shareholders in most cases, if it's a public corporation, maybe if it's a private corporation, then just the owners. And then you've got the debt holders. And so essentially capital is asking what percentage of the assets of that corporation are funded using the shareholders' money, and that's the capital ratio. And then versus what percentage of the assets of that corporation are funded with the debt holders' money. Yeah.
Okay, so this was a class on two questions.
Yes.
Use the word equity.
Yes.
Where does that fit in this equation? And secondly, what's the relationship between this ratio and something I'm used to seeing, which is like the leverage ratio? Is this just the same thing or something?
So it's a little bit different. So usually in a very simple sense, we would define equity as this assets minus liabilities. So we can call that equity. And then, so this is closely related to a leverage ratio. So usually, we're going to define a leverage ratio as the value of assets divided by the value of equity. So you could, write a relationship that relates these two, but basically speaking, if you
think of assets as an accounting measure, or are you going to infer it from the market value of the stock?
all of the above.
They're different.
I know, so I'm going to consider them all.
Okay.
Yep. So basically the higher the capital ratio you have, the lower the leverage ratio you have, and vice versa. And so within the banking context, there are these regulations that the federal government imposes that basically set a minimum for the amount of capital that a bank needs to have. And effectively then what that is meaning is it's setting a maximum leverage ratio that a bank can have. And the reason why, so one of the most common reasons that gets talked about for why would you want to regulate the capital of a bank is that the more capital that the bank has, the more money it can lose before it goes insolvent. So a bank goes insolvent when assets are less than liabilities. And then it's going to probably get thrown into a bankruptcy of some sort, or at the very least going to have to require some kind of workout amongst its creditors. That can be very disruptive. And so one of the main reasons that the government regulates capital and why people are interested in it is the bigger assets are compared to liabilities, the more of a buffer you can have, because if the bank makes investments, those investments start not going well. An investment by a bank could be a loan. If the loans don't get repaid, that's going to start reducing the value of those assets that the bank has, because if a loan doesn't get repaid, it's not so valuable as its current. And so the bigger assets are compared to liabilities, the more buffer you have to lose money before the bank becomes insolvent. So that's a standard reason why capital is regulated. But what I'm asking here is there maybe an additional reason that regulators might be interested in capital, and in particular, might it also have an influence on the risk-taking incentives of the bank? So the reason that that's interesting is it's frequently, regulators are always debating and politicians are always debating capital ratios. It's one of the hottest topics in bank regulation, and which, is a field that's, hundreds of millions of dollars are spent every year lobbying on. And in particular, there's frequent calls to reduce capital ratio requirements. In other words, to allow banks to fund a smaller portion of their total assets with equity and allow them to fund a larger portion with debt. So what this work might have a relevance for is if you reduce those capital requirements, one obvious effect is it would increase the probability of bank failure because there's a smaller cushion to absorb losses. But there's the potential that it might have a secondary effect that would further exacerbate that by increasing the probability of failure by changing the riskiness of the underlying portfolio. In other words, changing the probability that the bank is going to suffer a big loss at the same time as reducing the ability of the bank to withstand that loss. And so if regulators are only looking at capital as relevant for the purposes of absorbing losses, but not in determining how big those losses are or how likely they are, they could badly miss the mark, and they could maybe cut capital ratios by a bunch, think they're going to be okay, and then, as Warren Buffett says, when the water goes out, you see who's been swimming without a suit.
I haven't heard that one.
You haven't heard that one?
No.
Yeah, no, it's a great quote by Warren Buffett. He says, when things are going well, everyone looks like they're a great investor, and everyone looks smart, and it's only when the tide goes out that you see who's been swimming naked. So that's Warren Buffett for you. Okay, so that's the motivation behind this. There's a lot of financial theory that undergirds this kind of investigation, that influences both the dissemination of it as well as the direction of the specific analyses. I'm just going to go through it relatively briefly. I figure either you know it or you don't. If you know it, you don't need it again. If you don't, you're probably not that interested, and or I can't fully cover the theory. As well as everything else. But basically, like I said, there's this potential for an asset substitution problem in the sense that asset substitution just means lower NPV, net present value. That's probably, does NPV make sense to everyone here? Okay. So there's the potential for that. That could be particularly strong for banks. So the thing is, this asset substitution problem can exist for any leveraged corporation, but it might be particularly strong for banks because they also enjoy deposit insurance, which they get from the Federal Deposit Insurance Corporation, and it's almost impossible to get the pricing of that insurance to perfectly reflect the risk. And to the extent that insurance doesn't reflect the risk that the bank is taking, then that creates a potential further incentive for the bank to amp up risk, because the greater the risk the bank is taking, the greater the chances it's going to get a payout on that insurance policy.
Well, the bank doesn't get the payout, the depositors get the payout, but the presence of insurance might make the depositors more willing to make the deposits without looking too carefully at that.
Yeah. So you can look at it like that. I mean, in some respects, from a simplistic theory, you can say, oh, well, the bank does get the payout, and then it passes it on right to the depositors. But yeah, I think
the management gets fired.
Well,
and
yeah.
The shareholders get wiped out.
Yeah. Well, maybe. And that's where that gets to the second type of insurance. So there's both an explicit FDIC insurance, but there's also something that's come to be known as too big to fail insurance, which is the notion that goes back at least to the 80s, that there may be certain financial institutions that are so big and important and connected to other institutions or connected to politically powerful interests that the government simply will not allow them to fail or will not allow their creditors to take losses. And that can serve as an additional type of insurance, and there's an increasing amount of empirical work that's documenting that if you look at things like the spreads on bank debt for large interconnected banks, it seems like there's something that's going on along those lines. So the effect may be particularly strong for large banks. Also may be particularly strong given how high the leverage of banks are, and the simple reason for that is because when we talk about this asset substitution problem, really at the heart what it is it's a conflict between the interests of the equity holders and the interests of the debt holders, and it enables the equity holders to take risks that they're going to benefit more from than the debt holders will, and the more leverage an institution get, the bigger those conflicts become, and the lower the incentives potentially of management to seek to ameliorate those conflicts, because doing so would transfer value back away from them and back to the debt holders. And given how highly leveraged banks are, that can be particularly relevant. And finally, there's the fact that bank investments have real consequences on the real economy. So for instance, there's been a lot of work that's been done in the aftermath of the financial crisis showing what happens to communities, for instance, where there have been a lot of banks making risky loans and then those loans go bad and there's a lot of foreclosures. Some of my other empirical work looks at quantifying and establishing some of the causal relationships between those negative externalities of high-risk lending in an area and then what happens to the economies of the area when those loans go poorly. So these are some of the considerations that are undergirding this. Okay, so before I go further, I want to see like how many people are with me. Are there sort of fundamental questions to address or anything like that before I go further? Because I don't want to have like left a third of the class and then just sort of proceed on and have to be like, well, I have no idea what's going on. I've just given up. So are there questions or anything like that? Like kind of making sense, at least what we're going to try to do, why, what's going on with all this stuff. Okay.
Very clear.
Okay, great. Okay, so one of the hardest things about this, studying something like this, is that banks are private competitive corporations. They do not, if they can avoid it, want to widely disseminate to the public detailed information about their balance sheets, about precisely what investments they're taking onto their asset books, how those investments perform, all of that. If they can possibly avoid it, they like to not make that publicly available. And so, but really that's exactly what you need if you want to do this kind of an investigation. So you want to have information that matches specific bank assets to the specific bank that holds those assets. You want information that identifies when the asset is acquired and some metric of the outcome of that asset. If it's a loan, maybe knowing if it defaults or not. Maybe if it's another kind of trading asset, you'd at least want to know what kind of profit or losses the bank is making on it, or some sort of volatility measure, something like that. You'd like to be relatively certain that these are assets that get held on a bank's book. So if the bank just sort of acquires an asset and then quickly sells it, maybe that's not so useful for understanding the bank's incentives for populating its own asset sheet. And ideally, you'd like all of that available for someone outside of the government to license, since I'm not in the government. So, and most researchers aren't. So a lot of respects, the biggest contribution of this research is just developing data that has never been put to use in this way before, because it's very difficult to get the kind of data you would need to do this investigation. In the past, people have tried to sort of proxy for this information. So one type of information people have used in the past for this is something that's called call reports. This is a regulatory disclosure that is made by banks on a quarterly basis. It gives very broad level information about the bank's balance sheet. So it gives information like the percentage of loans that the bank has made that are in different broad risk categories. And those include things like commercial and industrial loans, or US Treasury securities, or home mortgages. So we'll give percentages like that, which is something, and that's been a lot of what prior research has used. It's very challenging though for a couple of reasons. One of them is that those risk categories are very crude. They've been widely criticized in the literature as not being accurate reflections of risk. Even more fundamentally though, there's the problem that when you see a bank and you see, okay, it's got this percentage in this type of asset and this percentage in that type of asset, you don't know when the bank acquired those assets. It could have been 2 years ago, it could have been 5 years ago, it could have been 10 years ago. We're dealing with home and business loans. Those can have long terms, 5, 10, 20 years terms, and therefore you don't know what the capital levels of the bank were when it acquired those. if a bank could easily and cheaply adjust its portfolio to match whatever its current risk preferences are, then maybe that wouldn't be so much of a problem. But there's an obvious lemons problem where if you have a bank that's held a loan on its books for 5 years, it's going to be very, very difficult for that bank to sell that loan to someone else, because the bank is going to know a lot more about that loan than whoever it's selling it to. Whoever they're trying to sell it to is going to be very skeptical that the bank is just trying to offload the bad loans and keep the good ones, and that information makes it difficult to infer that. The call reports also give information on, for instance, broad statistics on what percentage of loans are performing or non-performing. That suffers from the same challenge. You don't really know when those loans were acquired, and so there's some substantial challenges, and those have been recognized in the literature. So people who've written on this previously have said, we wish we had better data on this. We don't, we're going to have to use this. People have also looked at stock returns of banks, and they've looked at, are banks that have more capital, as we're talking about here, did they do better in the financial crisis or worse, and what was their portfolio, what was their stock return volatility during crisis periods. Those are informative, but they kind of miss the mark for at least this type of an analysis. And one of the reasons is that there's a lot of mechanical effects apart from everything I've said about call reports, which also really applies to them. You don't know when the assets were acquired that are driving a bank's portfolio stock return volatility. But even beyond that, there's a mechanical relationship between leverage and risk that functions through a number of channels, including what Lisa Goldberg has been demonstrating in her research, that is going to exist regardless of the underlying riskiness of the assets on that portfolio. And there's no good way to disentangle whether the extra leverage is coming, at least it's quite difficult to disentangle whether the extra riskiness is coming from the mechanical aspects versus the actual underlying portfolio composition. Yeah?
What do you mean by mechanical aspect?
Well, so, there's just the simple fact, so there's a couple of them. So one of them is that, if you have a higher leverage, then that is going to, and you own, X equity and 10X assets, then you're going to be getting, 10X of your volatility on those assets. So in theory, you could try to just sort of divide, the volatility and try to correct for that, but in practice, it gets very difficult.
So by mechanical, you mean the extra risk induced by the leverage itself?
You got it, yeah.
Because leverage is a risk multiplier for most standard risk measures.
Okay, so there's some challenges. So what I do to overcome these is I get a ton of loans where I know the exact bank that made the loan and the exact outcome of that loan. And so this is data that really has not been very available in the past. So I get 600,000 loans that were made to small businesses by banks. And this data comes from something called the SBA, or the U.S. Small Business Administration's 7A lending program. It's a program in which banks can partner with the U.S. government in order to make loans to small businesses. And banks, by participating in the program, get the option of buying partial default insurance on the loans. And so depending on the loan characteristics, a lot of times it's about 50% default insurance. So if the loan defaults, the government will make up 50% of the losses. Sometimes it can go up to 75 or 85% of the loans that the banks can purchase default insurance on. And I obtained this information via Freedom of Information Act request submitted to the Small Business Administration.
How long did it take them to answer?
Oh gosh. So the initial one was actually submitted by my advisor, Kai Gisaga, and then I followed up with a subsequent request. The subsequent one was not too bad because I actually was able to get to know and meet with the woman who's the director of risk an assessment for the SBA, and she was kind of interested in what I was doing. So the second one was not as bad. I don't know about the first one. I think it was something like a year, which is actually not bad as FOIAs go. Yeah.
Are these loans will be represented under the commercial and industrial loans?
Let me think here. Yes, I believe so. Yeah.
What percentage of the total commercial and industrial loans?
It's very small. So
1, 5? Kevin?
Well, let's see. So the total loan volume that I have covers, I think, $200 billion worth of loans for these, for all of the banks. So in terms of the actual percentage, it varies by bank. Different banks are involved different percents. It certainly is the case, though, that this is a window into the bank assets. It would be lovely if I had even more comprehensive one. I would not call it, in any way a comprehensive sample, or probably even necessarily a fully representative sample. Yeah.
Does the bank get community reinvestment credit for these loans?
Oh, it's an interesting question. I think it does, but I'm not certain. Yeah. I also use home mortgage loans, so one of the concerns, was coming up here is maybe this is an unrepresentative sample, so in a lot of respects to add additional robustness to this, I consider two different classes of loans, so I also consider home mortgage loans. I've got 1.2 million of these that I have, and where I get these information is it's through a merge of a couple different data sources. So here in the US, whenever a bank takes out a mortgage on a property, so if you borrow money from a bank, the bank is going to take a mortgage on that property. Basically, that means that they have the right to come and take that property if you don't pay the loan. But if the bank wants that mortgage to be legally enforceable, which most of them do, they need to register it publicly with the county registrar of deeds. And so you can go and collect this information, or you can get a data company that collects it and licenses it to you, and you can see precisely which banks have taken out which mortgages and which amounts on which property. Furthermore, the same county registrar of deeds is going to contain records of whenever property changes hands. And so what that means is what I can do is I can look at a particular property, I can see, okay, Wells Fargo took out a mortgage on this property, on January 5th, 2005. Then I can see 4 years later, there was a foreclosure sale on this property. And I see no intervening records filed with the registrar of deeds on that property, so I can be pretty certain that that mortgage defaulted and entered foreclosure. Conversely, if I see a mortgage taken out and then maybe 3 years later the property sells and changes hands, someone else bought it, then almost certainly that mortgage got repaid using the sale price. Or if I see that same person take out a new mortgage of roughly the same size as the old one, I can be pretty sure that the mortgage got refinanced, and so the initial one got repaid. And so I can start with using that kind of a logic to build histories of the performance of all of these loans that get taken out on individual properties. Now,
So you can tell whether that subsequent sale is by the same owner or
yes, exactly.
or by a bank.
Yes, indeed. Yep. Or a lot of times it'll list, the county sheriff's office as the seller when it's a foreclosure sale.
What about short sales?
Yep. So those are identified too, and so I consider a default for my purposes as either a foreclosure or a short sale. So now I do an additional step where I merge those mortgage records with something called HMDA, or the Home Mortgage Disclosure Act, which is another government database. This is actually freely available to anyone, and at least recent years. If you want further back some of the information, you gotta send the government a couple $100 and have them send you an old CD that only works on a really old computer. And it's a huge pain, but it's not hard to get this stuff. The Home Mortgage Disclosure Act is pretty neat. It's limited in some respects. It only contains information as of the time a mortgage was made, or it tracks it up through the end of the calendar year. But it's not going to give any information on whether the mortgage defaulted or not. So it's very limited in that respect. But it has this really neat feature that if the mortgage did sell, if the bank sold that mortgage to anyone else during the year when it was made, that will get reported. And so what this enables me to do is to screen out all of the loans that got sold to securitization vehicles or sold to other financial institutions, and lets me just focus on the loans that are held on the portfolios of banks, which is what I'm most interested in this purpose of. For this research, I want to know what are the properties of loans that banks are actually holding, rather than the ones they're selling. So,
Seems like putting together this database itself is already
It was-
tour de force.
it was years and years of work. I'm not like solid work, but I've been working on this. I think I was here 2 years ago, and I remember talking to you about starting work on this project at that point, and so it's actually very exciting for me to finally see it coming together into a project, because there was a long, long latent period in this work where all I was doing was building data and merging data and, you know, trying to develop a logic to turn these records, you know, and this is, I forget how many, it's like hundreds of, it's like, you know, billion, it's like at least a billion, or half a billion records, I think, in these deeds. And so turning those into, you know, contained records of individual loans, and straining out duplicates, and oh gosh, yeah, so it's huge.
So the deed records are
Yeah.
generally held locally.
Mm-hmm. They are.
How do you deal with inconsistent formatting and just going from
Yeah. So
recorder to recorder?
Sure. So fortunately, there's a company called Ohlrogge,
Okay.
which gathers that, standardizes it, sells it. I mean, it's still very dirty when you get it from Ohlrogge, but it's a heck of a lot better than if you had to do it from scratch on your own.
So how did you fund the data purchases?
Yeah, so I went department to department and asked them to give me money. And so, I mean, it's owned by Stanford University, so it's not me exclusively. So, you know, before I went to grad school, I was a community organizer, so I got very good at going around and understanding people, getting to know them, understanding their interests. So it was a lot of, you know, going and meeting with people, trying to convince them, oh, this data is going to be great, I'll let you do this great research. The library had, you know, some grant funds that it had. I got some personal grant funds that I chipped in. I mean, just every place. Yeah, because this was over $250,000 that it cost to buy this. It was part of a larger data purchase, but it wasn't cheap. It was like $250,000 to get this. It came as part of another data purchase. We also got some other stuff in addition, but yeah, data is really expensive. So I bet you folks have some pretty good data here in Berkeley, though. So I don't know exactly. Yeah.
So I'm pretty familiar with the HMDA data, and
Yeah.
I'm assuming you're assessing whether or not a loan was sold using
Yes.
the purchaser type field.
Yeah.
But that field, there are two papers that talk about how that
Mhm.
field severely underreports whether or not loans were sold.
Yeah.
And based on my own usage, I see weird things,
Mhm,
like
mhm.
Citigroup not selling a single loan in 2003. That
Yeah,
doesn't
yeah.
make sense to me.
Sure. So one of the things that I do because of that, I mean, there's an inherent limitation because it's only going to report the loan being sold if it were sold up until the end of the year in which it was made. So, you know, if a loan gets made in November and gets sold the following March, then it's not going to show up as being sold. And so what I do to address that is I actually only use records that are from the first half of the year. So that gives a better chance that you're going to be reflecting that. In terms of you know, whether or not they're being fully accurate in their reporting, I think that's a good point. I don't think I don't have anything magic that solves that. One thing I will say is that well, okay, so two things. One is that's why it's nice to have two different data sets to analyze. That gives you some robustness. If there, I'm pretty sure I do have Citigroup. It's possible they dropped out for 2003 if that's the case. You know, as long as that's not systematically correlated with their capital level, that's not going to be a big problem. It'll let most leads add some noise to my estimation. And furthermore, what I'm going to show is I use in this paper an instrumental variables technique, which is a statistical technique that further is able to sort of wash your estimates out from factors like that. And so that also is able to address that. Maybe none of those are perfect, but it's, you know, I think it's a decent response given the limitations of what you can do with data available. Okay, so my approach, I've got these loans, each linked to the bank that originated them. I'm going to observe the loan outcome. I'm going to predict the outcome based on the capital level at the time of origination. So everything that I'm predicting the outcome of these loans based on is only measured as at the time the loans were originated. I'm going to use bank and time fixed effects. So what this means from a statistical perspective is I'm going to be asking not just overall the banks with less capital make riskier loans, but if I look at the same bank, is it making riskier loans in times when it has less capital, or other words, higher leverage? And is it making safer loans at times when it has more capital? I'm also going to use time fixed effects. So I'm going to be asking, if I fix my window of comparison for a set point in time, 2003 or 2007, 2012, are the banks just at that point in time that have more capital making safer loans than the banks with less capital? I'm going to use those. I'm also going to use a statistical technique called the instrumental variable to predict capital in a way that's designed to be orthogonal from a variety of concerns that could inhibit the causal inferences that you would draw based on the correlation that you see. I'll talk a little bit more about that later on if I get to it. If not, you can read the paper and see details. And I'm going to discuss in more deep depth some of the specifics ways that these are all going to work together to help build a case that the relationships that I show are really representing a causal relationship, not just a correlation. Yeah.
When you say bank, are you talking about bank holding company or lender?
Yeah. So I do it both ways. It makes very little difference. So yeah, I do it both ways, and it doesn't make a difference. Yeah.
So the level of bank capital should be sensitive to the performance of the economy.
Yep.
Requirements to write down assets to the lower cost in market.
Yep.
And so you have some confounding, I would have thought.
So to the extent that those effects are common across different types of banks, then those are going to be controlled for by these time fixed effects. So for instance, if you have, maybe let's just say the economy is doing really well, and that's boosting, the values of those assets to the extent that that's relatively boosting them to the same amount for different types of banks at the same type of time, then that's going to be controlled for. I'm just going to be asking, okay, given that point in time, are the banks with less, capital making riskier loans? You might not be fully convinced by this, though. You could say, well, there's an awful lot of different banks out there, and they're going to be influenced in different ways. One of the things I also am going to do is I'm going to fit my model separately for different types of banks. I'm going to consider small, medium, and large banks, and I'm going to fit them separately. And so maybe the time fixed effects in the whole model is not going to be fully controlling for that thing. Another big issue is regulatory conditions. Those are changing. So, and so maybe you could also say that, okay, well, regulatory conditions are different for different types of banks. Maybe they're changing along different trajectories. So just trying to do a crude controlling for overall regulatory conditions, maybe that's not good enough. So in that case, I'm going to fit them separately for different types of banks. And so as long as they're relatively constant across these different types of banks, that'll control for it. And then finally, there's always the instrument to fall back on. Yeah.
So the time fixed effects is like a dummy variable for every month?
Yep.
Is that?
Yep, exactly. Yep.
And maybe you said this, I'm sorry if you did. How long is your full time horizon?
Sure thing. So I cover, it's slightly different for the two loans. It's 2003 to 13 for that, and 2003 to 12 for those.
And there's a lot of observations here, so really putting all those month variables doesn't even make it down.
No. And furthermore, though, what I am going to do to enhance this credibility of the bank fixed effects is I'm going to also fit my models over subsets of the data. So I'm going to fit them over 5-year rolling subsets of the data. In order for the bank fixed effects to be credible, they are able to do a great job at controlling for unobserved factors of a bank that are relatively constant across time. But if those unobserved factors are changing across time, they're not going to work. And so by fitting my models over sub-periods of my data, I'm able to enhance the credibility of those, as well as also to get more information about, are the results just being driven by, a particular odd outlier period, or are they more of a systematic relationship that's persisting across time? So there's a number of, let me see actually, okay, so I'll give you a preview of my results, and then I'm going to talk more in depth about these sort of identification challenges of concluding, is this actually a causal relationship that I'm seeing? Basically what I find that a 1-point increase in Tier 1 capital is going to decrease the probability of mortgage foreclosure by 4%, going from a mean of 2.5% to 2.4%.
Wow.
So it's quite substantial. I find that the effects are the largest for largest banks, which is consistent with some of this theory about an additional layer of too big to fail insurance. I will say that when we're talking about these capital ratios, we're talking about them ranging from, roughly speaking, like 5 to 15. So a 1 point increase is pretty big. I mean, you're not going to see like a 20 point increase. The basically post financial crisis in Dodd-Frank, we saw across the board capital levels go up by about 5 points. So you can roughly infer that maybe if we would have had those pre-crisis, we would have had a 20% or so reduction. So it's substantial, but it's not like, it like completely reshapes everything.
Do you have significance measures?
Oh yeah, this is all very significant. I'll show you that specifically, in the table, so this is a little preview. For large banks, I find a 1 point increase in Tier 1 capital decreases the probability of small business default by 9%. And I find that these have a large impact on the macro economy beyond just the balance sheet of banks. And so in particular, if I consider counties throughout the United States and I calculate the mean capital ratio of all of the banks in a county during the pre-crisis period from 2003 to 2006, and I use that to predict how many foreclosures are going to occur in that county during the crisis period of 2007 through 2012, I find that a 1 point increase in average Tier 1 capital is associated with a 4.4% decrease in foreclosures at the county level. So this is relevant not just for the balance sheet of the books, but it's also having a big impact on the economies of these areas. There's been tons of research showing that when these foreclosures jump up in areas, house prices drop down, that reduces money that's coming into local governments through property taxes, employment goes down because people are spending less, all sorts of negative impacts from these foreclosures.
And just to,
Yeah.
so I understand, to be as clear as possible.
Of course.
You believe that these reductions
Yes.
are attributable to asset substitution?
Well,
Banks are being more careful when they...
so I would say it in two respects. I think they're attributable to the risk incentives of capital. One thing I will say is I provide suggestive evidence. When I think asset substitution, when I use it here, I'm going to mean specifically the making of lower NPV loans. And I'll be upfront that nothing in my research directly proves these loans are lower NPV. There's a lot of suggestive evidence that they're lower NPV, but I don't have enough. You need a lot of really, really detailed data to really make a convincing case about the NPV of a loan.
Well, let's just say riskier.
Yes, but I do believe that. Yes, and I'm going to try to convince you of that with some of the tools that I use. Yeah.
So I'm just, do you have anything in your data with which to comment on the pricing of these loans across banks?
Yeah, so I have a little bit. So I do have some information on the interest rates of the loans. It's unfortunately not as comprehensive as I would like. For some of the loans, it's missing that information. But I do find that the banks that are making the riskier loans, the low capital banks, are charging higher interest rates. So that suggests that they are aware of the extra risks. I also show furthermore that the banks with less capital, when they're given the option to buy default insurance on the loans, they actually buy less default insurance than the higher capital banks, which is interesting because you might think maybe they would partially compensate for the added loan risk that they're taking on by buying more default insurance. And in fact, they do the opposite. They double down on their risks by buying less default insurance. So the fact that they're buying, less default insurance, that's another sort of upfront decision. It's a concrete decision. It's not just bad luck that they're making. So I think it's pretty clear that they know at least on some level what they're doing.
So you specified the temporal structure in the
Yeah.
third bullet. Is it the same in the other two bullets? That is the capital measures from 2003 to 6?
No, so for these other ones, I'm going to be measuring it on a quarter-by-quarter basis, and I'm going to be looking at, just predicting the default rate of loans made in a given quarter based on the capital level of the bank that quarter. So it covers the whole time
So is
period.
it possible that in those two bullets, the defaults are driving the capital ratio and the other way around?
Certainly not, because the defaults don't occur until much after the loans are originated in almost all the cases. So
I see, so it's default in a loan position that period.
correct. So, like I said, there's definitely challenges in terms of drawing a real causal relationship between a correlation between high capital and low loan risk One of the challenges can be, it's been well documented that, for instance, CEOs and other top managers can have pre-existing risk preferences. And if you have, for instance, a risk-loathing CEO, that might cause her to want both a high leverage strategy, because that's going to amp up risk, and a high asset risk strategy, because that's also going to amp up risk. And if that's the case, then you would see a correlation between high leverage and high risk, but it's not that the high leverage is driving the high risk. Instead, it's that they're both driven by this third factor, the risk preferences of the CEO. And in that case, if you say, okay, well, I'm going to implement capital regulations to force a lowering of leverage, it might actually have the opposite effect that you want, because maybe that CEO is going to be like, okay, well, you've reduced my risk by reducing my leverage, I'm going to compensate by even further amping up my portfolio risk. So that could cause a spurious correlation between high leverage and high risk. Another possibility is that when regulators require higher capital, they might also more carefully scrutinize other aspects of bank safety. And so, for instance, in that case, you might have a situation maybe post-crisis, the regulators are increasing the capital requirements, which they did, but if they're also more closely scrutinizing other aspects of bank operations, then you would see a situation where you have high capital and low risk, but that's not because the high capital is making the loans less risky. It's instead that there's, again, this third factor, the regulators, that are driving both the high capital and loan risk. So that could those could both cause a spurious correlation in one direction. You'd also get a spurious correlation in another direction. So, for instance, it's actually been well documented now that banks that make riskier loans sometimes do more to inflate their capital ratios artificially as compared to banks that make less risky loans. And so if you get that, you could actually have a situation where you see a bank making really risky loans but seeming to have really high capital. And then you think, oh, okay, high capital means high risk instead of high capital meaning low risk. It's not the real relationship, though. It's because of this distortion of the capital ratios that are reported. Another possibility could come from regulators. So they might view capital and their other supervisory functions as substitutes. So maybe you're a period where you've got low capital requirements, maybe the regulators are uncomfortable with those, wish they could maybe raise them, but they're constrained by various factors of political economy. So they decide, well, we have more latitude in choosing how closely we're going to supervise the other aspects of the bank's operation. We're going to try to do that extra hard to make up for the low capital of the banks. Or conversely, then you get into a situation where high capital regulations, the regulators feel they can breathe a little easier. The banks have what looks like a good buffer, and they're like, okay, heck, go wild, make whatever loans you want, you can absorb the losses. Then again, you get a situation where you have high capital banks making high risk loans. It's not because the high capital is driving the loans, instead it's that the regulators are going lighter on them. So what am I going to do to overcome these? I'm going to, like I said, use bank fixed effects. So to the extent that you've got a constant either CEO or just even the compensation practices for managers in a firm, if that's relatively constant over time, that's going to get controlled because I'm going to be asking for the same bank, is it making riskier loans when it has less capital? I'm going to use these time fixed effects, changes in regulatory conditions, market conditions. I'm going to fit my models over different time periods like I talked about. I'm going to fit the models over different types of banks, and then I'm going to use an IV. So a variety of strategies to deal with these. So now what I want to do is start just showing you some very descriptive evidence of what kind of relationships we've got here at a base level, and then I'm going to get into the more formal statistical models. Oh yeah, so here's my model. So I'm going to represent the probability of default. This is loan I by bank J at time t. I'm going to represent it as a conditional logistic regression. I use that to deal with the bank fixed effects, so I don't get a incidental parameter bias if I used a more traditional logit. I'm going to represent the probability of default as a function of the capital at the time of origination, a bank fixed effect, a time fixed effect. In some of my specifications, I'm going to use a vector of macroeconomic controls. I'm going to use in some specification a vector of additional bank controls, and then an error term. So this is the basic framework. I also have other analyses that are slightly different forms. You can read more about them in the paper. I probably won't get to them in this presentation. So what does just the overall data look like? What I've done here is I've taken all of the small business loans, and for each loan I figure out how much capital did the bank have when it made that loan. I take the range of those capital values, and I divide it into 50 bands with roughly equal number of loans in them. So for instance, maybe I'm going to have a band from 7.5 to 7.7. I'm going to find all the loans that had, whose banks that made them had between 7.5 and 7.7 for their capital ratio at that point in time. And I'm going to find what's the average default rate for those loans. I'm going to plot that on this chart. So what we start seeing here, it's a little bit of a fuzzy relationship, but it's at least a relatively suggestive, more moderately downward trend of higher capital correlating with lower loan risk. Yes?
Sorry, is this absorbing your controls already, or is this?
No, this is
raw.
Yeah, this is very raw. I'm going to do some plots that absorb some controls, but there's only so much you can do in a plot. So this is very raw. So one of the details is when I talked about this first, what capital is and what this capital ratio is, I said, okay, we have equity and we have assets. But in reality, how do you define equity? How do you define assets? That's very difficult. There's a lot of different ways to do it. In the paper, I consider 14 different ways of measuring capital and capital ratios based on different ways of measuring both equity and assets. In this presentation, I give a smaller subset of them, but I will cover a couple of different ones. So I don't think I have time to get into the details, but let me just say this is one way of defining capital. We see a relationship here. I'm going to switch to another way of defining capital. We see much the same relationship, but actually gets a decent amount tighter. I'm going to switch to yet another way of defining capital. It gets even tighter, at least up to about this point. It kind of fades off here. I will say, though, that at this threshold here, we're at twice the regulatory minimum. So we're in a relatively unusual situation for banks when we're getting over here. So these plots so far cover the small business loans. They cover the whole time period of the study. You might ask, well, what if we look at just a particular point in time? So I can do that too. So just for variety, I'm going to do home mortgage loans. I'm going to fix them at a particular point in time. The plots would look almost identical if I did them for the small business loans. So here, this is just loans made in 2005. So, presumably these issues of the regulatory conditions, the market conditions are relatively fixed. As we fix the time period, we see that same kind of relationship for 2005. See the same kind of relationship for 2007. We see the same kind of relationship for 2012. Some years it's stronger, some years it's weaker. But you always see a very consistent negative trend of higher capital correlating to lower loan risk. So it's at least giving you some suggestive evidence. What this plot here does is this combines a bunch of these different definitions of capital. These first three are the ones that I showed you. These are measured at the individual bank level. These next three are those same measures but measured at the bank holding company level. There's very little difference overall. These final two are interesting. So for these final two, and this gets to the question one of you was asking about market cap. So maybe there's some problems with how you measure this equity. It's based on some accounting terms. Another way you can value the equity is to just look at the stock price for a bank, multiply that stock price by the number of outstanding shares, and you get a sense of how much is the bank based on that. And it's very interesting because when I do that, we actually start seeing the opposite relationship as we see up here, which is kind of puzzling. So here we see higher capital banks making safer loans. Here we see the exact opposite, higher capital banks making risky loans. Yeah?
So, what would you include in the denominator?
Yeah.
To compute market cap to risk-weighted assets
Uh-huh.
for $100 million in U.S. Treasuries?
So U.S. Treasuries are given a zero risk weight.
Exactly.
Yeah.
So there seems to be a confounding or a bias where banks with lots and lots of really high quality assets
Yep.
are going to have a very small denominator.
Mm-hmm.
And that is simultaneously boosting the ratio of market cap to risk-weighted assets.
Yep.
And also predisposing them to have higher quality assets.
Mm-hmm. Yeah. So it's a great point. I'd say there's a couple of responses that I take to that. One of them is I also include in my capital measures that I analyze these total assets. So they're going to be less susceptible to that. A treasury security is going to show up in face value.
But that's not as good a fit.
It's true. It's true. The other thing is, as I'll show you, I'm going to do this IB strategy, which is also designed to control for that. So it is an interesting puzzle, though. We got a negative relationship here, a positive relationship here. Can the statistical models help us make more sense of that? So this is the first of my models. What I've done here is I've considered so panel A and panel B are considering two different types of measures of capital. The first one is this regulatory-based one. The second one is this market cap-based one. Each of the different columns is different control specifications that I use in the model. And so what we see here is we see a strong negative relationship. This first panel, or this first column contains no control, so it's a pretty close analog to the plots I was showing, and we see it reflecting. We get a strong negative relationship and a weaker positive relationship for these two. But it turns out there's actually a very simple explanation, because as soon as I throw in just these three very simple macroeconomic controls for returns on the stock returns, treasury rates, and unemployment rates, what we see is there's a very clear pattern. When the stock market is doing well, when unemployment is low, banks make riskier loans. Why exactly is that? There's a variety of plausible explanations. Maybe they feel more optimistic about the economy in general. Maybe they feel better positioned to take risks just because they're getting a lot of revenue coming in from other sources. They can better absorb them. The specific details are not important, but what is clear is that banks are making riskier loans when the economy is doing well, and when the economy is doing well, it's boosting their share price. And so as a result, you get this seemingly spurious relationship between high capital and high risk. As soon as you throw in those controls, though, you get a very consistent negative effect. So you flip them into both associating high capital with low risk. Here I throw in a variety of other controls. This rightmost one, column 6, is my fullest model, where I'm using bank controls, year fixed effects, macroeconomic controls. I do actually lose statistical significance here on the regulatory measure. I'm not worried about that because I'm going to show you plenty of other places where the regulatory measure is strongly predictive. But here I've got a very significant result here for my market cap measure. Yeah.
Sorry, how can probably missing something? How can you have time fixed to fix and then the macro controls that only vary over time?
Yeah. So it's a good question. Basically, so I measure the macro controls on a month-by-month basis, and so I'm looking at the month that I measure the loan. So that's it. So.
And by adding controls, you just need adding new regressors.
Yes, precisely. Yep. So these are the small business loans. Now I'm going to consider the home mortgage loans, doing the same set of analyses. Again, we see the same pattern. We start with a strong negative and a positive for the regulatory versus market cap. The instant we throw in these three simple macro controls, we get a consistent strong negative. We go to the fullest specification here. Now we've actually lost the significance on the market cap measure, but we get it for the regulatory measure. One of my findings overall is that there's no clear winner in terms of the different measures of capital. I never ever find anything where you get like a significant positive relationship. So I'm not really concerned that there's a little bit of fluctuation. But one of my conclusions overall is that there's actually value in looking at a variety of these different metrics and ways of yeah.
5-year trailing return, right? Has a due date.
Yeah. I also try it with other specifications like 3-year or 1 year or whatever, and that doesn't make a difference.
You might try indexing the market cap by bank ETF, so that then you'll see
Oh, that's true. Yeah. Add that as other control.
overall bank equity deflator.
Yeah, that's a good idea.
So it's interesting the significance flips between the two measures in the two different markets.
In which column?
Well, you lost in the previous slide. You lost significance in the top half. And
Yeah.
the bottom, and now it's flipped.
Yeah, that is. Yeah.
Do you have any speculation about
To be perfectly honest, I've thought about it. I don't know for certain. I don't have anything super convincing as to why that would be. I mean, there are different types of loans, but beyond that, I guess I might say that it could. Okay, if I had to guess, I would guess that there may be some sort of a market premium on sort of banks that is making high risk loans. Maybe somehow enjoying that, but I don't really know. It's a good question.
Do we know what effect the crisis had on small business defaults? 'Cause obviously,
Yeah, they went up.
These big corporate defaults a lot.
Yeah, they went up a lot. I don't have it here, but on the paper I've got like a chart that sort of shows the default rate of the small business loans, and they do go up a lot. Yeah. Here I'm going to break things out by size of bank. So I'm going to consider small banks, which I define as between or less than $17 billion in assets, medium banks as between 17 and 340 billion, and large is greater than that, and fit the model separately. So actually what I see here is I see essentially zero relationship, no statistical significance, no consistency of sign for the smallest banks. For the medium ones, I see a relatively consistent negative relationship and pretty significant. And for the large banks, it's really, really strong and clear. And it's interesting because we get twice or more the effect size for the largest banks as for the mid-sized banks. So this is some potential evidence in support that maybe there is this too big to fail effect that's providing a larger incentive for the biggest banks to be amping up their risk in response to low capital as compared to the small and medium ones. This is now looking at the stability of these relationships over time. So like I said, I'm going to fit my models over 5-year subintervals. And for each one of these, then I find the coefficient estimate on the capital variable, and then I compute the 95% confidence interval. This is clustering errors at the bank level. And so, and then these are just considering these different measures of capital. So it's pretty clear from me looking at these pictures, we got a very clear, strong negative trend. Results in the negative, generally statistically significant. Some of the submodels, you lose it a little bit. Overall, there's some discrepancy in terms of the size of the effect from year to year, but you generally see it pretty well for an awful lot of the years and the time periods. So what I take from this is both, it's giving me some assurance that these bank fixed effects, are doing a relatively credible job. It's not like they somehow fail because when I'm fitting them, these models have bank fixed effects, time fixed effects. This is the full model, that column 6 of those previous slides. I'm still getting pretty significant and consistent results. And also it seems like it's not just that there's like one total outlier, that's the only one that's significant and everything else is sort of blah. So that gives me a little bit more additional assurance that this is a real relationship. Finally, I'm going to talk about this instrumental variable strategy. How many of you folks are familiar with instrumental variables? Okay, so for those of you who aren't, let me think the very simplest way I could say it is it's sort of a way of trying to find a natural experiment where you find a way to randomly, or at least quasi-randomly, choose certain banks to get a reduction or an increase in their capital level and find then what are the impacts of that. From a more mathematical perspective, the way it works is it's a 2-stage regression procedure. And so in the first stage, what I'm going to do is I'm going to try to predict capital based on at least one factor that I'm going to argue is orthogonal to any of these concerns, these confounding concerns that we have about risk manager preferences and distortions from the economy or distortions from regulation or all of that. I'm going to predict the bank capital as a function of that exogenous factor and my other standard predictors. I'm going to then obtain the predicted values from that regression, and by definition of those predicted values, those are going to be orthogonal to the error term. In other words, they're going to be orthogonal to every other factor that I've left out of that regression, like these risk manager, like these manager preferences, like these regulatory things, as long as those are not correlated, as long as that error term is not correlated with my regressor that I'm using as an instrument. And then I'm going to take those predicted those predicted versions of the bank capital, and I'm going to use that in a second regression in place of the real bank capital. So by construction, I create a set of capital variables that are orthogonal to all of these other confounding concerns if, and this is the big if you buy the argument that the external factor that I'm going to use to predict that capital is indeed independent of those. If you don't buy that, then the whole thing falls apart. I do have at least partially going for me that I use something that was already published in the Journal of Finance. It's moderately accepted, but it doesn't mean it's true. My work wasn't published yet in JF, but I I steal an instrument that was. But it doesn't necessarily mean it's true. There's some sketchy stuff that gets published these days. So basically my goal is I'm going to predict capital levels of banks making loans in a particular CBSA, that's a core-based statistical area, basically means a metro region. So here I think we've actually got like 3 CBSAs in the Bay Area. We've got like Oakland East Bay, we've got San Francisco, we've got South Bay. So it's like a metro area that's sort of economically intertwined with each other. And the concept is that the capital levels of banks will be impacted by the local economic conditions of the communities in which they operate. So basically what I'm going to do, in a nutshell, is suppose I'm looking at Wells Fargo, and Wells Fargo is making a loan in San Francisco. So Wells Fargo also has operations in a lot of other places in the country, in New York, and in Omaha, and in Texas. And how well local economies in California and in Texas and Nebraska and New York do, how well those local economies and other places where Wells Fargo operates, that's going to impact Wells Fargo's capital levels. But if I'm controlling for time fixed effects, what happens in New York should be pretty uncorrelated, and what happens in Nebraska should be pretty uncorrelated with what's happening in San Francisco. And so what I'm going to do is I'm going to look at changes in the property level values, and this is going to be during the Great Recession period, in areas, all of the areas outside of San Francisco where Wells Fargo is making a loan. I'm going to use those to predict the capital level of Wells Fargo when it's making this loan in San Francisco. And then I'm going to do that for all of my banks that operate in at least 2 core-based statistical areas. So the assumption here is that after you control for like these economy-wide effects, that if you just look at the economic fluctuations in the other communities where a bank is operating in, that'll give you an exogenous source of variation in the capital levels. So that's the overview. Here's some of the mathematical details. I don't have quite time to go into it, but that's the general gist. You can get more details from the paper. And then once I've done that, I'm going to take these predicted variables, these predicted capital values, use those to predict the default. I'm actually going to switch just to a simple linear regression for this rather than the conditional logic, because it makes the math and the computation of the IB a lot more tractable. And I'm going to fit my model. And so it's a much smaller sample period now because I'm doing a reduced period of time, and also not all of my banks, because I can only use banks that operate in at least 2 regions.
This is so what's on the left hand, it's not probability of default.
Yes, exactly. Yeah. Yeah, so it's just, you got it. And so what I see here is I'm continuing to get strong and significant results from this IB specification, again showing that basically the banks that took a larger hit on their capital are making riskier loans. Banks that took a smaller hit or gained on their capital are making safer loans. So it's giving it added assurance here that it's a real causal effect. Yeah.
How many unique banks do you have here?
Oh, so in the study or in this so I think there's about 300 in the bigger study, and then I think this goes down to like 120 or something like that for the small businesses. For the mortgages, it's more like 500 and 200. So we've got that, and rather than showing you more, because I think I've really got, this is that last one on economics in the counties. So I'm going to predict the foreclosure rate in a county as a function of bank capital. My actual analysis includes a lot more predictors than just this. You can read about all of them in the table notes in the paper, but what I see is a strong relationship between, again, higher capital and fewer foreclosures in these counties. So there's like a minute or 2 left. I'll just see if there are other questions or anything like that. Yeah?
You control for mergers. So, for example, Bank of America
Yeah.
has a lot of foreclosures and defaults.
Yep.
But back in 2003 to 2006, they were not a major player.
Yeah. Well, so this is not going to be impacted one way or the other by mergers, because I'm just looking. Okay, so it's a great question. So actually, this is a different source of data for the defaults. So this is a broad. So this is the other part of that CoreLogic data that we paid all the money for, and this covers like 70% of the entire loan market based on mortgage servicer information. And so all I do is I look at the county where the bank where the loan is, and count the total number of foreclosures in that county.
So I think the question is, what happened to the countrywide mortgages? that-
Exactly, so mean capital of
Yeah.
BFA in 2003, 2006 has
So that's going to reflect
questionable relevance to its foreclosures in 2007 and 2012.
I don't know, because, so basically, 2003 to 2006, huh?
They didn't make the loans, Countrywide did.
Yeah, exactly.
And they bought Countrywide, so.
Yeah, so Countrywide had a bank,
Yeah,
and that bank had capital,
right.
and that bank is going to be influencing this measure of
So
capital.
the point is you attribute those defaults to countrywide, not to.
Yeah.
BFA.
Exactly.
How do you know that their Countrywide loans since 2007 to 2012, they would be on the base books?
I don't know that there are Countrywide's loans for any particular loan here. I'm just asking, in a given county, how many total foreclosures do we see? So I'm asking, you know, there were loans that were originated in 2003 to 2006. They were originated by banks with a specific amount of capital, and we can know that capital, and once the loan was originated, there's nothing more to know. I'm not looking at, you know, any kind of effect of like how active were the banks in refinancing the mortgages or anything like that. So once the loan is made, that information set is total. And then I'm asking how many foreclosures occurred, regardless of who owned them in the county in 2007 to 2012.
And your deed information as the originator.
Yes.
It's,
Yeah.
the registrar doesn't go back and revise the ownership.
Correct.
based on
Correct.
subsequent
Yeah.
mergers.
Yeah. Great. Other questions? Well, thank you so much. It's been a delight being here and presenting, and I'll be around afterwards if you have more questions. So thank you all.
Thank you.